All right, let's get started. Welcome everybody. Thank you for being here for another Beer Money Sunday. I've got mine. Hope you got yours wherever you're coming at to us from the Bowtie Nation. Alcoholic, adult beverages or not. Thank you for joining us. I love doing these live streams. Trying to do them every other Sunday or when I can. I've actually been out of town for the past 2 weeks. Visiting different parts of the country, and then up into Tampa and Florida. Actually went up there to look at some houses. Going to be moving here, hopefully within the next couple of months. But again, thank you for joining us. Got a great video planned for you today. The Santa Claus rally, and will it save the markets? I think this is obviously after last week's bloodbath in stocks. After the last 2 weeks, I think the Nasdaq is down something like 6% over the past couple of weeks. Investors are wondering, what's going to save stocks? How do I prepare for 2022 and what's going to happen? So I wanted to talk about the Santa Claus rally because I think it's something that is, and I just realized I misspelled Santa Claus in the video there, but we'll get that changed, and it is not Santa Claus with an E. Anyway, I think the Santa Claus rally is something that's misunderstood by a lot of investors, even in the media, about when it happens and kind of the historical background behind it and why it happens, even more importantly. So we're going to talk about that, whether we'll see it this year. We'll talk about why stocks are falling, and why up may actually be the most likely direction left. Why up might be the possibility or the probability over the next few weeks at least. Then we'll talk about how to invest for the rest of the year into 2022. Some of the stocks I'm watching for this week, as far as longer term as well. So let's get into that. I'm excited. First, I want to just draw your attention to a link I posted in the chat, pinned up to the chat there. If you want to see the top 5 stocks in my portfolio, no matter what, these are the 5 stocks I'm buying, whether the market goes up or down. Click through that link. It's going to be a free report from the Motley Fool, something I did in partnership with them. You enter your email address and they'll send you that free report, the 5 biggest stocks in my portfolio. And these are, those long-term, decade-long picks, right? The long-term 10, 20-year stocks that I'm holding no matter what, and I think could really go quite a bit higher. So click through that link. I'll leave it in the description below as well. You'll enter your email address. Absolutely no obligations. Totally free. Now the Motley Fool is going to send you some emails asking you if you want to be a part of their stock advisor program. I'm a member of that. They've got some great advice analysis on that. So I've been a member of the stock advisor program for quite a while. No obligation though. You don't have to sign up. Just get that free report and you'll be supporting the channel. So I appreciate that. Helps me do these live streams when I can. But we're going to get right into it. Next week, we're wrapping up the series of videos that we've done, 5 videos following Brian and Crystal, 2 members of the Bowtie Nation, 2 citizens of the Bowtie Nation, I guess, following them over the past 5 videos, some of the things they've been doing as far as side hustles, passive income, and starting investing. It's a really inspiring story and a great story. And I recommend, even if you're not interested in something like a beginner investors, beginning stock market or starting investing, even if you're not interested in some of these topics, click through and watch those, because it is really a great story of how they really turned it around from 2019, buying a truck they couldn't afford and really living paycheck to paycheck, to creating a side hustle income from their mowing business. Crystal's passive income business from her Etsy shop, which has just done amazing since February. And then how they started investing and how they're growing their portfolio with that. So not only some great information on how to do some of those things, but some great inspiration from somebody that's just like me and you out there in the nation. We're gonna, again, like I said, like I was talking about earlier, we are going to start doing some daily videos in January, so be watching for those. Excited about doing that as far as what we're seeing going forward. Now, I want to get started though, because like I said, with the past 2 weeks, with the Nasdaq down 6% from its highs, and with some of the sell-offs we've seen, I know a lot of you out there are asking, what's happening with stocks? Should I be worried? Is the stock market going to crash next year? Things like that. So I wanted to cover first what's happening in stocks here, what's really driving these sell-offs, and then we'll talk about the Santa Claus rally, and then get into some of the stocks I'm watching and a strategy for going forward. So, stocks last week on Friday, we did have a relief rally on Wednesday. And what's really telling about that rally that we had on Wednesday, and basically that was after Chair Powell of the Fed came out with a statement, came out a little bit more hawkish than a lot of people had expected, and said, basically we are on track for probably 3 rate hikes in 2022. The Fed is going to raise its federal funds rate, its interest rate, probably 3 times in next year, which is a far cry from what we started the year at. Starting the year, we had a lot of members of the Fed saying no rate hikes in 2022. Most economists thought maybe 1 rate hike at the most. And now they're saying probably 3, right? I was talking about before, I even saw President Dudley, and it's a president of one of the Fed on the Fed board, say that we could even see a rate hike by March. Okay, so we're talking the Fed lowering its asset buying program, so it buys $120 billion in bonds every single month, pushes that money out in the economy to kind of boost the economy. It's a stimulus. We're talking about them taking that off by March, which would be a very quick schedule, much quicker than most people expect, and then actually starting to raise rates by March. I don't think that's going to happen. I'm going to talk about why that's not going to happen pretty soon here. But basically what we saw on Wednesday, that relief rally of like 2% or more in stocks, tells me that now the market is seeing that as okay. A more aggressive Fed and even inflation is okay. It's not something that's going to hit the market, and they've priced that in. Okay, right now in the market, in stocks, those 3 rate hikes are priced into stocks. So what happens with that is if we see any kind of evidence, and I think this is where the Omicron comes in, and I'm going to talk about that later as well. If we just see any kind of evidence where that might not happen, where those 3 rate hikes might not happen, where the Fed might slow down its taper a little bit, then that's going to be a positive catalyst for the market. It's going to mean more stimulus for longer, lower rates for longer, and I think that market's going to take that as a positive cue. The sell-off in the rest of the week seems like it was a function of those Omicron fears, right? And we'll talk about that. Those have really looks like it is going to become the next surge. Because those previous winners like Teladoc and the ARK Innovation Fund, the ARK-K, really surged as we saw the cyclicals, so energy, financials, materials, and industrials selling off. So again, what this is telling me is that the market is looking at the Omicron variant, is looking at the coming surge in cases, and saying, okay, you know what, we're going to go back to some of these lockdown names, these restriction names like Teladoc, like those innovative growth stocks and lockdown stocks in the ARK Innovation Fund, and it's selling some of the economically cyclical stocks. It's selling the stocks in energy, in financials, in banks, in materials and industrials. It's selling those because it does see the Omicron getting worse, not necessarily total lockdowns like we saw last year, but still some restrictions. And in fact, I think President Biden has announced he's going to have an address on Tuesday discussing the Omicron. We just saw New York on Friday reported to hit its highest daily case ever of the whole pandemic. Okay, highest caseload ever on Friday in New York. And there's just no doubt a surge is coming from this Omicron. It is spread more easily than some of the other variants, than the Delta, but it is not as lethal. Okay, and so what that means to me is that, while we will get a surge in cases, we probably won't quite see the kind of lockdowns and economic slowdown that we saw earlier with with some of the other surges. With that vaccine effectiveness, we still see the vaccines, the 2 doses are effective against people, keeping people out of the hospital and keeping lethal conditions. We have a pill coming up from Pfizer that is a treatment for the symptoms once they do materialize. So that's positive. So all this is really just telling me that that shift to lockdown stocks from cyclicals might be kind of temporary. What you want to do is if you look at any of the other past surges, the surge we had earlier this year on Delta, the surge we had last year, on some of those other variants. Those cyclical stocks, so energy, financials, as well as the travel and leisure stocks and airlines, cruise lines, things like that, they started rebounding much earlier than we actually saw a peak in those cases. And in fact, I can show you where to find this kind of information. Let's look at this. I want to bring this up for you. This is where you can kind of look at that caseload and the information. Okay, so you go, you can type in current cases COVID-19, and that'll bring up these. I usually go scroll down here to this worldometers.info. And if you click through there, if you go to the United States one, you go countries, United States, I mean, you can see the daily caseloads for daily cases reported for each one. And then if you scroll down even further, you'll see daily new cases in the United States, and this is all the way back to February of last year before we had any cases. So and what you can do is you kind of match these dates up with what we saw in the stock market. Okay, you match these up with what we saw in travel stocks, what we saw in some of those cyclical sectors like the I'm going to X out this. So those cyclical sectors like energy stocks, like bank stocks, things like that. And you'll see that a lot of those stocks, they started rebounding well before we hit these peaks. Okay. So in, the peak of January 2021, early January, and then we had another peak for that Delta variant in September 1st, around early September of 2021. But you'll see if you look at those stocks, they actually started their rebound very much earlier, actually a few weeks earlier. So what I think you want to do here is, knowing that the Omicron variant is going to create a surge. And in fact, I've seen reports that the flu, the regular flu might be even worse this year as well. What you got to understand about the flu is that each year they create a vaccine for the flu to take for the flu, right? The yearly flu vaccine. And they create that based off of what they think the dominant strain, what the dominant type of flu, because there's all kinds, just like we've seen different strains of the COVID, right? We've seen Delta and Omicron and all of those. There are different strains of the flu going around every single year, right? Well, what the authorities, the health community tries to do, it tries to say, okay, which strain is really the biggest and the baddest this year, okay? And then, early in the year, it starts developing the vaccine around that strain, right? So it's trying to protect people around that specific strain and, some of the other related ones. So two things for this year. I've seen data that says that they kind of misjudged the dominant strain this year, that the vaccine they're putting out for the flu isn't quite as effective on that dominant strain. So, you're probably going to get a lot of people that even are vaccinated for the flu this year don't have that kind of immunity, and they're still going to get ill with that. It's still going to protect you from hospitalization and some of the lethal symptoms, but it just won't protect you necessarily from just getting the flu like it does in past years. Also, though, what you got to understand with the flu each year is a lot of the immunity that we have, and a lot of the what we have against the flu each year is from the people that have immunity from having the flu the previous year, right? People have the flu in the previous year. They build up that natural immunity to it. Even the ones that weren't vaccinated, ones that were vaccinated, or the ones that caught the flu that last year. And then that carries over. We all know that the vaccine immunity, as well as that natural immunity from having a virus, it wears off, but it does last about a year. And so a lot of the reason why we see lower years of flu is because maybe the year prior, a lot of people had the flu, and so they still have that natural immunity. Well, last year we had the lowest ever on record number of flu cases, and it's because people were masking, people were social distancing, all that kind of thing. So lowest number on record of people globally in the U.S. as well that had the flu. So what that means is people don't have that natural immunity this year. So again, we're probably going to see a very bad flu season this year. The Omicron is hitting, and that's being more transmissible, but not as lethal. So both of those are going to hit this year. So that's why I think maybe you hold off, and we'll talk about that in this stock so that I'm watching for this week. Maybe you hold off on some of those travel and leisure stocks, maybe some of the cyclical stocks like energy, like banks, like materials and industrials companies. You hold off on those for maybe another week or two, because I do think as you start seeing the flu counts, the virus, the COVID counts go up, it's still going to spook the markets a little bit. But again, if you look at the prior peaks to COVID, do not wait until you think it's the peak of that surge to start buying back into these stocks, into those travel and leisure stocks, into those cyclical stocks, okay? Because they're going to start rebounding well before that peak. So some of those things that I've been watching over the past week, some of the things that the reasons why I think the market is selling off. Again, I do think the Omicron is actually kind of a positive catalyst for the market. Like I said, we are now pricing into the stock market at least 3 rate hikes next year. So if Omicron comes along and people start saying, okay, you know what, we're getting a little bit more restrictions, we're getting a little bit more lockdown because of this virus surge, maybe the Fed doesn't hike quite as fast. Maybe we only get two rate hikes next year. And so that's going to be a little bit more positive for the market. Okay, now I want to talk about, what is the Santa rally, the Santa Claus rally? When does it happen? Why does it happen? How you can build that into your investing strategy and what it might mean for stocks. And then we'll get into, how to invest for 2022, that bigger picture, as well as some of the stocks I'm watching here. So now the Santa Claus rally, you'll see this all over the internet on CNBC and whatever. And a lot of people like to say, it's much larger and much broader and for a longer time frame. Really, historically, it's only been the last 4 trading days of the year. So those last 4 trading, not even this next week, but the last 4 trading days of December and the first 2 of January. And so that's been really the kind of the definition of the Santa rally, when that has occurred. And it has been a rally, in data back to 1950. The S&P 500, this broad stock market index, has gained 1.3% during those last 4 days and the first 2 days of the year. So about 6 days, really about 1 trading week. It's been up 1.3% over that period on average. It's occurred in 78% of the years from 1993. So about 18 out of those 27 years, that period of about 6 days has been positive, has been a positive for stocks. So it is something that does happen. It is one of those weird reoccurring anomalies that does seem to happen. And I think a lot of it is really just positioning by institutional investors, right? You've got these big money managers, these fund managers that are really a lot of times locking in their returns for that year earlier in the month. Okay, and we really saw this towards the end of November, beginning of December this year, when the stock market was going down. Is because a lot of the institutionals, they were looking at 20% return on the S&P 500. Positive double-digit returns in their funds. They wanted to lock that in, right? They wanted to say, hey, I don't know what's happening the rest of the year, but I want to lock in this 2021 gain. When 2022 comes around, I'll deal with that, but I want to lock this in just so I can book a positive return, get my bonus next year. Right. So now, obviously, that's going to create some selling pressure, some downward pressure on stocks late November, early December, just like we've seen. And then, a rally. Then that Santa Claus rally is when those investors come back into the market, start positioning for their next year. Right. So it's, usually that last week of December, that first week of January, when they start positioning, buying back their stocks, buying back different stocks for that next year. Okay, so that's really why the Santa Claus rally happens. You're going to hear a lot of other excuses for this, like maybe institutional investors, those big money managers and fund managers are going on vacation, those last few days of the year, and really leaving it up to the more bullish retail investors. You'll also see some other reasons. Coming from when I worked on Wall Street, worked with some of these major banks, and that. I don't really buy it. We always had, the end of the year, you start seeing a lot of analysts go on vacation, a lot more traders go on vacation, but we always had somebody to trade stocks. Okay. It's not like Goldman Sachs just empties out the whole office and nobody's around to make a trade if news comes around, right? We always had people around there trading on different news stuff. So I really don't buy the argument that it's just retail investors pushing stocks up. I think it's much more this institutional side of the market, selling stocks earlier in the month to book those annual gains, and then coming back in, buying up what they're going to be holding for 2022 for that next year. And that's really the buying pressure that pushes stocks higher. Again, it's been a positive catalyst on the market, up 1.3% in the last 5 trading days of the year, and the first 2 since 1950 on average, rally 78% of the time. So it has been pretty predictable in pushing stocks up. Will we get one for this year though? And I think we will. I think we've sold off that part of the market because a lot of those institutional investors have booked those, have sold their stocks and put that downward pressure on the market. And again, I think I think a lot of the worst case scenario with the Fed with rate hikes is priced into stocks at this point. Investors are waiting for those 3 rate hikes. If we do get, Omicron heading higher, it's going to be a downward pressure on the market. It's going to be, remove some support because of economic growth, but it's also going to say that, maybe the Fed can wait a little bit longer. I do think we get institutional investors coming back into the market, but I think it's more likely, not necessarily a rally right in these last few days of the month in those cyclical stocks or in the travel and leisure stocks, because I still do think Omicron is going to be, driving those prices down. But I think you do get a rally in, some of those lockdown stocks, some of the stocks, the growth stocks, the tech stocks that did work well, earlier in the year during the lockdowns, during the pandemic and that kind of thing. In fact, JP Morgan had a research report out early last week, I think, that it's calling for a short squeeze, a possible short squeeze in a lot of these ARC innovation type stocks, right? You've got like things like Tesla, you've got things like Teladoc. I know Teladoc right now has about 15% of its shares outstanding borrowed to sell short. A lot of these stocks. See if I'm online now. Stop streaming. Let me know if I'm still online. We had a little power outage there, so I want to make sure that we're still streaming and we are still online. Okay, looks like we're still here. Okay, all right. But again, I think a lot of these ARC innovation type stocks, right? These growth stocks, things like that, have sold off 40, 50, 60% even in some cases. And they're just oversold, right? On a technical basis, oversold as far as positioning oversold as far as positioning for hedge funds. So I think a lot of these hedge funds, these other institutionals, they come back into these growth stocks in the end of the year. So that's where you're going to see those Santa Claus rally in these kind of lockdown stocks. Yep, there is some stuff on the screen. For some reason, my info from the camera came up, so we're gonna just let that go as it is. So I do think we get a Santa Claus rally here in the next 2 weeks, as well as early January. You see those institutional investors coming back, for stocks. How do you invest for longer out though? Into the rest of the year, into 2022. Again, I like those growth stocks into that Santa rally and the beginning of next year. And market seems like it's pricing in all the pain from those rate increases, and I think some of that comes off with the Omicron build. And the valuations have come down quite a bit. Earlier in the year, we were looking at growth stocks. Some of the stocks in the ARC Innovation Fund priced at 20 times on a price to sales basis, right? Investors were paying $20 for every dollar of sales that these companies were booking over the previous year, which is just ridiculously high. Okay, a lot of these stocks have now come down into the $7 to $8 $8 on a price to sales basis, which is still kind of high. I usually try looking for stocks under 10, even those growth stocks under 10 times on a price to sales basis. So a lot of those stocks have come down. I want to show you how to find some of these. When I say ARC Innovation stocks, those stocks in the ARC Innovation ETF, I'm not necessarily talking about the innovation fund itself. It's a good fund. I've owned shares in the past, but I don't own shares right now. I would much rather pick some of those stocks myself. But what you can do is you go to the ARC Fund's website. And this is a lot of times, if I'm looking for some of those innovative companies, those the companies, this is what I'll do. I'll just go to the ARC Innovation ETF. I'll go here to the ARC Innovation ETF, the ARKK. And on any ETF, you can do this. Any ETF, you go to its website and you go to here to holdings, and it's going to show you exactly what's in the fund. And the reason why I like to use ARC Innovation here is, Kathy Wood and the team there over at ARC, they do have some great research, some strong research on these types of innovative growth companies, these things that are changing the way we live as far as technology and innovation. So I like to see their research. I like to see what they're buying. I don't necessarily, doesn't mean I'm necessarily going to buy everything they own. So I don't want the fund itself, but I am looking through here to find some of the stocks that I think can do well. And so just in this fund, just in the top 10 here, and you can download the full holdings. If you click one of these, you get full holdings, and you see exactly all like 55 stocks in these in this fund. You see Tesla's up there as always number one with these. Roku, Zoom Video Communications, Teladoc. I own Teladoc. I own some of these others. Exact Sciences. I own that. So you can just look through here, and that's what I mean when I say these ARK innovation stocks. Not necessarily the fund itself, but just some of these growth stocks that they're looking at. And again, I do think these will get a boost. They got a big boost on Friday, and I think they'll do well over the next couple of weeks. Not only on that Santa Claus rally, but as the Omicron surge gets people scared about those lockdowns and those restrictions, and gets them coming back into these into these lockdown stocks. So that's really what we're talking about there. Further out into 2020, what you can look at, what you can start looking at. I do still like the cyclicals, and when I say cyclicals, I mean those sectors, the sectors of the economy that are sensitive to the cycles of the economy, right? So we're talking mostly about energy here, financials, so banks, companies mostly. We're talking about materials companies, which are going to be, steel producers, manufacturers. They're going to be miners, things like that. The industrials, which are going to be your factories and other manufacturers, things like that, right? So I do still like those next year, but not before we've seen a few weeks of the Omicron, right? Again, I think the Omicron surge is going to scare a lot of people off on this. So you're going to have pressure in those cyclicals, just like we had last week. But eventually, that's going to come off, and again, it's going to come off before we get a peak in the, in the Omicron variant. So again, financials, probably my favorite sector this year and next is the bank stocks. Just with, even if the Fed doesn't raise interest rates 3 times next year, they're still going to raise at least twice. Interest rates are going to go up. And that's really going to help the banks. Okay, banks make more money when interest rates increase. Okay, so you're going to see the banks make more money anyway you slice it. They're going to do well. Energy, even with energy prices staying right around $70 a barrel, you've got a lot of energy companies that are very profitable right now. They're not investing. They're looking further out and seeing, maybe slower oil demand in the future. So they're not investing on those new fields. So they got mountains of cash flow. So I think one of the biggest stories of 2022 is going to be dividends increases, share buybacks by a lot of these energy companies that are no longer investing quite so much in the future, but they're returning that cash to shareholders. So I think, again, one of the big 2022 news pieces is going to be how much dividend increase you get from some of these energy stocks. Again, on that, I like Chevron, CVX. That's always been a very good one because they have a lower cost basis to produce. They produce at a much lower cost basis, which means obviously, wherever energy prices are, they're going to make more money. Exxon has actually got one of the higher cost bases, so they're very sensitive to oil prices. So as oil prices go up, Exxon stock does better. But if oil prices come down, Exxon stock gets hurt even harder. So I would stick, I'm a little bit more risk averse. I would stick with some of those other ones. I know Total has a low cost basis. Chevron, like I said, as well as RDS Shell, which actually I think dropped the RDS just recently. It's now just Shell. They have a lower cost basis as well. Discretionary stocks, consumer discretionary stocks, as well as travel and leisure. So, your airlines, things like that, those are probably going to be down here in the next couple of weeks on that Omicron, probably going to get hit because obviously, the people are looking at maybe more restrictions, more lockdowns, and not quite as much consumer spending. I think that goes away very quickly. I think, consumers, households still have trillions of dollars in savings that they didn't have before the pandemic, and I think that money is going to be put to work. We're seeing signs of a very strong holiday shopping season already, and I don't think the Omicron is going to stop people from doing that. So I think you see a rally into those consumer discretionary stocks. Those are retail names, things like that, and I'll show you how to find those too here pretty soon. I think you see a rally in those ahead of the first quarter earnings, and even in those first quarter earnings as we get that positive news from those earnings. Okay, or the fourth quarter earnings. Excuse me, the fourth quarter. So what I'm talking about here. Let's go back to here, and what you can do to find whenever I talk about stocks in a sector, you go to the sector tracker, and this is the sectorspider.com. So that's sectorspdr.com. You'll see up here in tools, you'll see sector tracker. Okay, and this is a great resource. This is one I use multiple times each week. And not only is this going to track all the sectors, it's going to show you how sectors did. So over the last week, it tells you the S&P 500 fell 2%, almost 2%. It tells you how stocks in each sector of the economy did. So we saw that big sell-off in technology and energy, in consumer discretionary, as well as some stability, some safety in healthcare, real estate, utilities. Okay, so not only some of the stocks that I'm going to talk about here in a second, but also just that higher level of investing, right? What stocks are getting hit by the current market environments, the current market news, that kind of thing, and which stocks might be safety in that. And what you can do here is once you get beyond that higher level investing and you start looking at stocks within each of those sectors, and whenever I say like the consumer discretionary sector, you can go here, and these are all the stocks in the S&P 500. Okay, these are the 500 largest companies based in the United States. So not every company, not every stock, but definitely a very good list of stocks here. And you can go here and you click on any of these. So we'll click on the consumer discretionary sector, and you see all the stocks in there. Okay, and you can even see same time frames, day, 5 days, 3 months, a year, up to 5 years. You see how well they've done. And so we've got just over 20, probably about 23 stocks in the S&P 500 in this consumer discretionary sector, right? These are retailers, these are clothes, these are gambling, these are the things that you buy, but you don't really need to buy them. Okay, they're discretionary things. Okay, and so we can look through here, and you can see what might do well. If I say that a consumer discretionary might get hit in the next couple of weeks as that Omicron surge starts to build, but it's going to have a very good, late January, early February, because those fourth quarter earnings, companies are going to come out late January, February, even into March. They're going to come out and start reporting how much money they made, their earnings in the fourth quarter of the year over that holiday shopping season. And like I said, we're seeing signs of a very strong holiday shopping season. So I think those earnings are going to be better than expected. I think they're going to be very good earnings. So I think, in the weeks leading up to those earnings, these stocks start to rebound as people kind of position for that, as people buy ahead of the news on that. And then I think you get that positive news in the fourth quarter earnings as well. So you can look through these and kind of decide, which stocks you like in that consumer discretionary play. You can also, if you want to play contrarian, see, okay, which stocks have really been hit hardest, or which ones do I want to maybe buy the dip on. You can see some of these. Gap has lost 30% in the last month alone. Best Buy down 24%. Etsy down 21%. Some of these, maybe if I can increase the size here, maybe you can see it a little bit better. So you just go through these, and Best Buy, it's probably primed to benefit from that holiday shopping season. So if you do believe holiday sales were better than expected, you do believe that Best Buy is going to come out and report a good first or fourth quarter earnings, then now might be the time to pick up some shares of Best Buy. It might be time to pick up some shares of Gap, things like that. Obviously you want to do a little bit more research analysis in why it's come down so much, why it sold off so much, maybe Etsy, things like that. But I think, like I said, I think consumer discretionary stocks do very well. This Etsy is interesting because this is, obviously one of those lockdown stocks, kind of an online retailer kind of idea that has come down quite a bit over the last month. And I think this is one of those stocks that does well over the next couple of weeks, even, as we start seeing money get back into those lockdown stocks, into those restriction stocks. So that one might do well. I haven't really looked at Etsy in a little while, so I don't know what the fundamentals are there and why it's come down so much. But just check those out. And that's really kind of what I'm looking for 2022. Again, I still like the cyclicals. I still like financials, bank stocks, especially materials and industrials will do well on the industrial or on the infrastructure bill that money is now going out. Those travel and leisure stocks, as well as consumer discretionary stocks, will do well eventually, as we get closer to the peak in the Omicron surge, but not necessarily just yet. Now, now I want to talk about kind of, some stocks I'm looking at specifically for this week, some stocks that are reporting earnings maybe, or have some things coming up. One of those is Nike. Nike is reporting earnings. Actually, I think it's reporting earnings before the bell Monday, so maybe not time to get in on that. It might be after the bell. Check that out. But Nike is reporting earnings. It's down 6% over the last month, mostly due to the Foot Locker earnings. Okay, so Foot Locker reported its third quarter earnings about a month ago, and that sent the shares down of Foot Locker shares down 23% over the past month. And Foot Locker did not have a good third quarter, and they didn't say good things about upcoming sales either. So for Nike, sales growth, anything positive is going to have to come from China, right? Foot Locker didn't do well. Nike's probably not going to do well in the U.S. either. So that sales growth, anything positive we hear from Nike is probably going to have to be from China. And I'm thinking that might disappoint as well. The property sector in China has been selling off massively over the past few months. So that probably wasn't a good third quarter. Consumer sentiment around that. You got to understand about a third of all wealth in China is invested in real estate, right? For the longest time, people really haven't been interested in stocks, haven't trusted stocks, so they've been putting their money in real estate, which has always gone up. China had a decade-long real estate, bubble inflating. Real estate prices always went up. People put money in real estate, even to let the properties set vacant. A lot of vacant apartments in China, and people were fine with that because prices just kept on going up. So a lot of money invested in China in real estate. That's come down. That's come down significantly over the past few months. So consumer sentiment is weak. People don't know how much money they're going to be making. They're not spending it on Nikes. Okay, so I'm thinking, Nike might be some downside risk on its earnings because of that China disappointment, and obviously, sales in the U.S. Here aren't great either. Also looking at airline stocks, they were actually able to rally on Friday, despite the COVID fears, despite the Omicron fears, despite the broader market selling off, airline stocks actually rallied. So I think that's some real strong support for those stocks, some buy the dip support, if you will. I'm not sure selling is over yet because, like I said, I do think Omicron becomes a larger surge than we've seen, larger than Delta probably, not quite as large as we saw in January this year, but it is going to be a surge, and it is going to hit those travel and leisure stocks like the airlines. So I'm not sure selling is over, but I would be watching this for maybe another 5%, maybe 5% down on some of these American Airlines, Delta, Alaska Airlines, things like that, to start building a position because they will rebound. It's also looking like we're having a strong holiday travel season. We were actually, like I said, we visited Tampa here this last week, so we had to take a flight, to there and back, and the planes were booked. The planes were packed. Okay, so I think the airlines did have a strong fourth quarter. They're going to start reporting that here in late January, February, and I think you're going to see some positive comments from that. But we do have to get over the next week or two with Omicron. So be watching airline stocks. Again, I think with airline stocks, I look at that a lot like I look at the energy stocks. Okay, so with energy, I looked at the cost of production for a lot of these companies. For airlines, I look at their efficiency and how many seats they need to be profitable. Okay, and if you look at that, if you look at capacity needs for a lot of these airlines, you'll see something like a Southwest, where there's ticker LUV, needs much lower capacity to start making money. I think Southwest is somewhere down in the 80s. Like they need 85% of their seats full to start making money, on each flight. Whereas American Airlines is much higher. American Airlines is in like 92, 93% capacity needs to start making money to be profitable. So, it just depends on where your risk is at, in this. If you're a risk-averse investor, if you want the upside but you don't want quite the risk, then maybe you go with a Southwest Airlines, which is going to do better even if travel doesn't come back quite as much. If travel comes back more, though, then American Airlines is going to do better, obviously, because, it's a little bit more risky. So obviously risk and return. American Airlines is going to do better. The stock is going to do better on a rebound if there is a rebound. If there's not a rebound, or if the rebound is really weak, then Southwest is probably going to do better. So something to think about as you're positioning for those airline stocks and that, that relief rally that we get maybe in a couple of weeks here. General Mills also reporting earnings. I think that's reporting earnings Wednesday, and has really bucked the trend. General Mills, ticker GIS, really bucked the trend in a lot of these consumer staples companies, these food packaging companies and food companies that we've seen, especially companies like I think ConAgra, as well as Kellogg's. Kellogg's is a good example because they're very similar companies. But General Mills is up something like 13, 20%, I think, over the year, whereas Kellogg's only up maybe 6%. So General Mills has obviously been able to maybe pass on those costs a little bit better. A lot of these consumer staple companies, you've got Campbell Soup, you've got Kellogg's, have been saying that their costs are going up, but they're not able to pass on all those costs to consumers, right? So their gross margins are coming down, they're becoming less profitable, and that's hurt the shares, that's hurt the stocks. General Mills really hasn't seen that. They've been outperforming. I'm not so sure that lasts though. They've got some great brands, but I'm not so sure they're that much different from Kellogg, from some of these other companies. And the valuation is already pretty high. If you look at the valuation, so on a price to sales basis, price to earnings, it's quite a bit higher than some of these other competitors like Kellogg's, like Campbell's Soup. I think you see some downward pressure on General Mills as well on that, especially if they start talking more about inflation and some of their own costs. One last here before we open it up to Q&A. Cryptocurrencies, Bitcoin is now down 32% and is looking like negative sentiment with a failure to rebound to its new highs. But if we put this into perspective, really, it's still up more than 100% this year, up 400% or so in the last year, which is just crazy, compared to bonds that have lost money, stocks that are up 20%, which is a really good year for stocks, but, crypto up 100% plus in a year. So, some sell-off is to be expected. You get these high-flying assets, these growth stocks and cryptocurrencies, they're going to sell off, when the market does. Sentiment is still remaining negative, so I wouldn't be surprised if there's some more price pressure down a little bit lower. But I think for me anyway, as a longer-term investor in cryptocurrencies, in Bitcoin, I own Bitcoin, Ethereum, Cardano, which is ADA. I own Matic, the Polygon token Matic, MATIC, as well as the Aave, AAVE. I own those 5 current cryptocurrencies. And I think the longer term fundamentals are still very much positive, very strong. I saw a recent BlockFi survey that said that found 1 in 10 people, 1 in 10 holders planned on gifting crypto. So that's obviously going to bring more people into cryptocurrency investing, going to bring more adoption into it with those gifting things. I think Robinhood is even actually starting a gifting program where you can gift crypto to someone else. And I think you're going to see that's going to bring in a lot more people, a lot of people into the space. Another survey by the American Banker estimated that 40% of banks are going to offer cryptocurrency services over the next 5 years. And that is huge. That's compared to, maybe about 10, 15% right now of banks offering those services. So all this is just to the point of bringing more people into cryptocurrency. I think 17% of Americans own cryptocurrency now. Another statistic I saw just this week that 83% of millennial millionaires, okay, those millennials, generation millennials under the age, I think that goes to like the age of 40, 20 to 40, something like that. 83%, so 8 out of 10 millionaires in that age group own cryptocurrency. Compared to just 4% in baby boomers. Okay, so, as we see these younger generations, the millennials, the Generation Z, as we see them grow into their prime investing years, prime earning years, these generations are very heavily invested, very heavily supportive of cryptocurrencies, and that's just going to build the adoption. That's going to build more money into cryptocurrencies. And and I think that's a very strong support for the prices, even though we still might see some negative price action here over the next month, or the next couple of weeks, even into 2022. If the price is down, I'll keep adding to my cryptocurrency portfolio because I think those longer term fundamentals support the price higher, over the long term. Now I want to open it up to question and answer. I'm going to scroll through here and check out. If I don't see your question, go ahead and feel free to ask it again. Make sure you use a question mark there so I know it's a question. I did see a super chat come up, but I didn't get an answer. Okay, Joseph Newman, thank you for that $4 super chat. I appreciate that. If you got a question, just let me know there in the chat, and I'll try to find that. Jay Fizzle, $5 super chat. Appreciate it. Thank you. What do you think of smaller oil and gas explorations like NOG, Northern Oil? They're growing and increasing dividend each quarter. So yeah, a lot of, what I'm looking at in the oil and gas, in the energy stocks. And this is a big reason on how we outperformed the index, how we beat the market in our 2021 Bowtie Nation portfolio is because we were early to that energy stocks and the bank stocks trade. Okay, we started in October, November of last year, that 2021 portfolio. We were heavily invested in energy stocks, in financials, because I saw what was going to be happening this year with energy prices, with interest rates, things like that. So we were able to beat the market on that. And if you look at some of these smaller exploration companies, they are very much more sensitive to oil prices, right? Especially the exploration companies that, they're not the big powerhouses like Chevron or Exxon that have, a lot of irons in the fire, so to speak. They don't have the different business segments that these larger players have. They are just exploration, right? So the momentum in the energy market is really going to be where they make their money. Oil prices go up, and these are the ones that they see the share prices go higher very fast. So you got your Northern Oil, your Energy, you've got your Devon Energy, DVN, you've got your Fang, which is the Diamondback Energy one we've bought in our portfolio. So you see, strength in the energy prices is going to be strength in those stocks. They are going to be more volatile, though. They are going to be more volatile around falling oil prices. I think maybe you get some pressure on oil prices here over the next 2 weeks as that Omicron builds, especially with possibly fear of falling demand for transportation, for airlines fuel. So I think it could be a rough couple of weeks for energy stocks, for energy prices. But then, just like we saw last year, I think energy prices do stay high. They do stay around that $70 a barrel or so into, through next year. And a lot of these, like I said, they're not investing in the future like they used to. They're not spending billions of dollars for new exploration. They're returning that to shareholders. So I think you see a lot of money returned to shareholders over the next year. Lose Cat, $5 super chat. I appreciate that. Thank you. What do you think of Ally stock? It's I really haven't covered Ally. I'm sorry. I mean, we can take a real cursory glance at the stock, but I haven't I haven't really looked at it. And which is funny because I have an account on Ally. I have an account on Ally Invest. They are a big if I can get the. They are a big supporter of the financial conference that I go to each year, so Ally Financial. What I will say is, I do like that they have a lot of different things. They're a digital financial company, which fintech is a very strong market over the next decade. I think they're going to do well. I haven't checked out the price statistics. The Ally Invest, the platform, honestly, it's a little bit more expensive, I think, than some of your than your Robinhood, your Webull, some of these other ones. So maybe not its competitive advantage there. So we see a price to book of 1.13 if we were to go to just on a valuation basis. 2% there. If you've got some of these others, so let's look at Synchrony, which isn't quite the same. Synchrony trading for a price to book value of 1.98, so quite a bit more expensive there. If we look at, let's look at Hood. I know if you're comparing it to Hood, it's going to be a lot cheaper. Even after the pretty massive sell-off that shares of Robinhood have had, I know it's still, so price to book of 2.34. So not quite as expensive as I thought, but still quite a bit more expensive than Ally. So, check it out. I do like Ally in that fintech space. It's obviously got a good valuation here, under 2 times on the price to book valuation versus some of these other fintech names. And again, I think it does a good job of outreach, of bringing more people onto the platform. But again, you definitely do a little bit deeper analysis in there. I have another 100 ruble super chat. I appreciate that. Thank you. Do you see upcoming milestones for BTC? So I'll move one way or the other. Great stream, by the way. Thanks, Ivan. I appreciate that. Always good to see you here in the chat every time we have it. In fact, I gotta take some more Go Juice here. All right. So BTC, short-term upcoming milestones. It's hard to say. I think, eventually we do get a spot ETF for Bitcoin. Obviously, that's going to be a huge catalyst. We've already got those. We've already got those spot ETFs exchanged or trading in Canada as well as other countries. Nothing wrong with them. They haven't been price manipulated or anything like that to harm investors. So I think eventually, the chair, the SEC chair Gensler, he has to come to he has to buckle to the pressure, basically, that he can't say anymore that, okay, spot ETFs are dangerous for investors, there's market manipulation, all that other crap, because we'll have evidence. We'll have years of evidence from the spot ETFs trading in Canada and other countries. And so I think that kind of argument for not approving a spot ETF here in the U.S. kind of falls away over this year. Obviously, it's going to be a huge catalyst, like I said. Upcoming milestones, I mean, real short-term milestones. Honestly, it's hard to see. I don't see it. I think inflation is supportive of Bitcoin. Obviously, it's not a direct hedge against inflation, but longer term inflation, it's going to be supportive of these real assets, and Bitcoin is a real asset. Some of these other cryptocurrencies are assets, things like that. So I think inflation is supportive. We get the PCE, the personal consumption expenditures data, out on Wednesday, which is expected to be another multi-decade high, is expected to be a high going all the way back to the early 80s. So I think inflation data does help Bitcoin marginally if it doesn't hurt the stock market too much. And I don't think inflation is really going to hurt the market that much anymore. Like I said, the market is pricing in 3 rate hikes from the Fed already. It's already many months of historically high inflation data. And so the market has come to terms with inflation. So I don't think inflation numbers are going to hit the market quite as much as they have, in the past, over the past few months. And I think that's good. I think that's good for Bitcoin because you've got that inflation support on real assets, but you don't get the sell-off in stocks. One thing I wanted to point out, if we're talking about inflation, is gold, because I see this, I'm going to see this question over and over again as we continue to see high inflation rates. And gold, one thing about gold is really interesting, really interesting here about gold is that it hasn't broken out of this range. Let's go to the year chart, right? Now, if you look at gold over the last year, it's starting the year, it was right around 1850, right around that top end of the 1850 range, right? It's really been range bound between 1700, 1725 to 1850 for more than a year, really. But if you look at this, it started the year right around there. Big sell-off here when interest rates went up, but it never really broke out. And we've had, 6-7 months of historically high inflation, okay? Inflation has been multi-decade highs for most of this year. And yet, gold could not break out of this range. Gold could not go higher than, it hit 1900 in May. But for most of the year, it has really been right around this 1750, 1780 range. It has not been able to break higher. So that's really telling. If you're looking at inflation and you're thinking, okay, gold should be going higher, but it's not. That really speaks to 2 things. One is, just the valuation of gold. It is fairly expensive. A lot of people going to look at gold, look at inflation and think, okay, gold's going higher, but gold's already high. Gold is already expensive. So I wouldn't necessarily invest directly in gold. What you see, another reason I think gold is kind of range bound or weak here is if you look at interest rates. Interest rates are typically a cost of holding gold, right? Because higher interest rates means you make more money in bonds, you make more money in other yield-bearing, interest-bearing accounts, right? Well, when you hold gold, you don't earn anything. You make nothing. So the higher interest rate is more of a higher cost on holding gold. So typically, as you see interest rates go up, then gold prices come down, right? And vice versa. As you see interest rates go down, it's less costly to hold that gold. You don't have any other alternatives. So you get the price of gold going up when interest rates going down. Now, what's happened this year though? Interest rates have come down. They're down to 1.4% lately. They've been up and down throughout the year, but they've still been down fairly low, even in the face of this very high inflation. And yet gold hasn't been able to break out. So gold's price weakness isn't a matter of interest rates, which it has been sometimes. It's not a matter of high interest rates. It's not a matter of low inflation. Inflation is super high, so that should be supporting gold higher, and yet it hasn't been able to break this range. So I would just warn you about looking at gold. The gold miners may be a little bit more supportive. Obviously, a lot of gold miners, if their all-in sustaining costs of production are down around, $1,200, $1,300, they're still making money. Gold here at $1,900 or $1,800, they're still making a lot of money, on their production, even if gold prices don't go up. So they have good cash flows, good dividends. So miners maybe, but gold itself, I would not. I don't think I would be investing in right now unless you see some kind of a big change in the dynamics in all that. What else we got here? Some questions. How does silver work? BM 365. How does silver work? Silver is really kind of a lot of times a function of those gold prices. Obviously silver has different supply and demand fundamentals, but it is very much also linked just to gold prices because it's seen as an alternative to gold as far as, an asset class. And in fact, what you can find is the gold to silver ratio, and we can look up this real quick because this is something I've traded on before. Gold silver ratio. You can look up the gold to silver ratio, and this is just the price of gold relative to the price of silver. So it's price of gold divided by the price of silver. Here it even says here what the prices are. So let's open up the calculator. So if you take about $1,800 per ounce of gold divided by 22.36 per ounce of silver, you get a gold to silver ratio of 80.5. Okay, which is right around here. And if you look at a little bit longer term, then you can get a sense of how these move together. And what I've done in the past is when that ratio becomes out of whack, then you can kind of trade up and down because these two metals the prices of these two metals are linked. So when you get a gold silver ratio down to 65 or 70 even, then that means gold is expensive, right? No, gold is cheaper. So if you had a gold to silver ratio of 70, that would mean gold would be cheaper, silver would be more expensive than it has typically been, in relationship. And so maybe you buy gold and sell silver. Vice versa, if it gets up to here in the 85 to 90 range, which is obviously higher than it's been in the past. We can go out a little bit further here. If you get up into the 80, 90, 95 range, then that means gold would be more expensive here. Gold would be more expensive than silver on this relationship, and so maybe you buy gold or maybe you sell gold and buy silver, or just buy buy the cheaper asset. Some of the things that I've looked for in the gold-silver relationship, because again, they are very closely linked. They different economic fundamentals, much more central bank buying in gold than it is in silver, things like that. But they are still very much linked as far as price. So, I don't do a whole lot of commodity trading, but that is one thing that I have done in the past to buy. Bullish silent strat says, any thoughts on CRISPR? And that's one of my long-term plays. That's one of the big ARC innovation stocks that we've talked about. CRISPR Therapeutics, basically this new biotech kind of revolution in creating gene therapies and things like that. Obviously come down quite a bit. We'll just look at the 1-year chart, and it has been brutal. Okay, $200 in January, now down to $82. So 120. That's great. It's about 60%, right? Something like that, right around 60% down off its highs. I like it. I own the shares. I actually sold a put option. So my cost basis for this is right around $120 for these shares. So I'm underwater on the shares, not quite as much as, maybe $200 a share, but I'm underwater on the shares, but I'm fine with holding it for a very long-term play. CRISPR Therapeutics, I think it's one of these innovation stocks. It's still expensive. If you look at the stats on this thing, as well as any of these ARK-K, so ARK Innovation, or ARK-G, ARK Genomics stocks, it's still fairly expensive. So more than 6 times on a price to sales basis. But it has a great balance sheet. Okay, so if you're, and basically this is what I look for just on a real quick cursory overview of a stock when I'm looking at a stock. Okay, I'll come here to Yahoo Finance and I'll look at the market cap and enterprise value. And basically this is just saying, okay, market cap is the total value of all the shares, the market value of the company. Enterprise value is if you take the market value of the company minus out the cash, but adding back the debt. Okay, so it's a very good indication of what is the real value of this company. Not necessarily market value, but the real valuation of the company, plus the debt. So any heavily indebted companies, you're going to see it here, or lots of cash. So, and you can look at this. I mean, the company has $2.5 billion in cash and only $205 million in debt. So basically no debt, $205 million, $2.5 billion in cash. It's very, very cash rich, which you see that in most of these biotech stocks. They have to have that cash stockpile to pay for their research and develop these new indications. But it's a good balance sheet. Price to sell is still a little expensive, but you would want to compare that against some of these other biotech stocks that you see. And I mean, sales growth is very strong. Okay. Quarterly sales growth. They just had some deals announced just in the last few months that quarterly revenue growth of, 400% plus, over that period, over the earnings, over the quarter. So I still like it. There could still be more weakness to come. Now, what you got to think about in these growth stocks, one thing you got to understand about these growth stocks is a lot of this has been driven by just massive amounts of stimulus and liquidity from the Fed. Okay, the Fed has increased its balance sheet to $9 trillion. All right, and what that means is that from about 4 or 5 trillion back after the financial crisis, right? At 2010, 2011, it was about 4 or 5 trillion dollars, the Fed balance sheet. And so that extra $5 trillion that it's increased, that's money it's pushed out into the economy. It's bought bonds, it's bought mortgage bonds, things like that. And it pays cash for that, sends that money out in the economy, and that's stimulative, right, to the economy. Where there's that money gone? It's gone into stocks. It's gone into these growth stocks, right? So, as that money now starts getting taken away, as the Fed reduces its balance sheet from 9 trillion to maybe, even 7 trillion or even 6 trillion, that's still $2 or $3 trillion of liquidity the Fed is taking out of the economy. It's got to come from somewhere. And if it's gone into these stocks over the past 2 years, it's going to come out of these stocks. So what I'm saying is that, you've got to have that longer term picture on these stocks, on these growth stocks that have really come up over the past couple of years. They still could do well. Like I said, I think they could do well over the next couple of weeks on that, renewed lockdown interest, that kind of thing, renewed growth stocks interest. But over the next year, they could be weak. But I'm a long-term investor in it, and I think you stick with it there. What else we got? Besides the Tesla is a government front. Not sure what you're talking about there, but okay, go ahead. Nvidia within a month. Again, I can't do short-term forecasts. Okay, I'm a long-term investor, fundamental investor. I can tell you the fundamentals behind a company, the competitive advantage it has over its peers. But what a company is going to do 1 month to the next, that's a crapshoot. I do know Nvidia has sold off recently, right? I think it bounced back Friday, but it sold off pretty hard. Nvidia. It sold off pretty hard before that, but it did bounce back Friday, right? It fell Friday as well. So that's kind of that's not very supportive. A lot of those growth stocks, a lot of those growth and tech stocks bounced back Friday on those Omicron relief rally. The fact that and I'll show you my screen here. The fact that Nvidia couldn't do that isn't supportive. It might not participate in this next 2 weeks if those growth stocks come back. It has come down quite a bit though. It looks like from mid-November down from 330 to 278. If we go out a little bit longer, 5-year chart, I mean, you can just see the run up in this stock. Just like all those other growth stocks, the run up that this has had. Even after the sell-off, 278. It was just 2 years ago. It was right around $55, $60. Okay, so that's the run up it's had. So don't think necessarily after a 14% sell-off that it's necessarily a cheap stock. Okay, don't fall into that trap of thinking the selling is over just yet. If it wasn't able to rebound Friday, it might have a tough time participating. It does look like the U.S. is going to try to block its acquisition of ARM, as well as I think the U.K. is also trying to block that acquisition. So that was a lot of what was driving this stock higher, was that acquisition was going to make it just indisputable powerhouse in these chips or in the graphics cards, and that doesn't look like it's going to happen. So, I would still, it's a great company. It is a leader. It is very much a leader in the space. But I would just still be worried about valuation here. I mean, you can go to statistics here and you can look at price to sales basis. It is price to sales 31.5 times sales. Okay, that's higher than Tesla. That's higher than pretty much any other stock I know. Okay, so obviously value investors aren't going to touch it. The growth investors, you'd have to, look at the growth rate, maybe price to sales to growth. If you want to, 50%. So it's still, even on a price to earnings to growth basis, it's still trading at 15 times, which, for reference, I like to go, if I'm looking at price to earnings to growth, so your price to earnings, so price to earnings to growth would be, it's 93 times price to earnings to growth would still be 45 times. Okay, or no, I'm sorry, my math is off. 93 divided by 50, it'd be 1.86. Okay, a little bit lower, but 1.86. But for reference, I'm usually, if I'm looking at price to earnings to growth, so price to earnings divided by growth rate in earnings, then actually, and that was sales, wasn't it? Anyway, whatever. Growth, okay, quarterly earnings growth 84. So let's readjust this. 93 divided by 84. Okay, 1.10. I'm usually looking for under 1.0. Okay, if I'm looking at price to earnings to growth, which is going to adjust these high price to earnings ratios for a lot of these growth stocks, give you a little bit better idea. I'm usually looking for at least, at the most 1.0, and this is 1.11. So yeah, it's still very expensive. I would not think the selling is over in Nvidia. Long term, it's a good company, but I'd still be worried about it. I saw a few super chats here I wanted to get to. Michael, $5. I appreciate that. Thank you. Would you buy more Palantir, ET, or Teva, or just hold? Do you feel the same about ET and Teva? Thanks and Merry Christmas. Merry Christmas to you, Michael. I appreciate that. Those are three very different stocks, right? So if I was looking at all three of them, and I actually own shares of Teva as well as shares of ET, Energy Transfer. But if I was looking at all three of them, I would want to, you're going to want to compare those against like companies, against similar companies, just to see how well they're doing on a valuation basis, on a sales growth, operating margin basis, just to make sure that those are really the best of breed in that industry. So first you start with that. Okay, are those companies really the best in their industry? Are they outperforming? Do they have that competitive advantage? And then if you're trying to decide on, maybe that helps you decide on the three of them. So if I found out basically that maybe among MLPs, ET is just the top-notch best, but among tech and that data security, data information kind of thing, Palantir wasn't quite there, then obviously I would want to buy ET instead because it's the competitor, it's the leader in its space. Teva as well as generics and drugs. Is it one of the best in its industry? Does it have those competitive advantages and help decide on that? Now, I really haven't looked at Palantir quite as much as the other two. Like I said, I own the other two. I like Palantir as far as what it's doing and some of the innovative ways it's using data and that kind of thing. But it's still very expensive, in my opinion. So I don't know that it does quite as well. It may benefit from the next couple of weeks if we see a return to growth stocks, but it is still a little bit more expensive than I'm willing to pay. Energy Transfer and Teva now. Energy Transfer, I like it. It's one of the best names in MLPs and master limited partnerships. It is a very strong cash flow stock. Again, I think we still see very strong demand for energy products, and I think that's going to support these MLTs. I like ET. Teva, I also own that. Teva is down around the lows that it's been trading at over the past couple of years. I like Teva at least up to $10 a share. I think it's down to I think it's down into the lower 8s right now. Okay, so we got Teva Pharmaceuticals, really the leader, really the largest generic drug maker in the world. It's down to 820 right now, and you can see if we pull back out, going back to mid 2019 when really a lot of the problems started surfacing for Teva, especially in those opioid lawsuits. It's really traded in a very narrow range. It's traded as low as $6.88, $7 here, late 19, and then as high as $12 or $13 here just earlier this year, and has come down. So again, I like it at least up to $10. With Teva, it's really all about those opioid claims and the lawsuits. I think those are finally getting wrapped up here in the next year. A lot of settlements in those, so you get a little less uncertainty around the shares. You start seeing Teva's pipeline come forward, come through a little bit better. So yeah, I do like Teva, and I own shares of that. What else here? I thought I saw another. Okay, Jonathan McHenry, $10 super chat. I appreciate that. Thank you. Thoughts on Tencent, considering it's trading on the OTC. Manish Probre, I don't really know him, but he's super bullish. Are you still bullish on Baba with a rebound regardless of being delisted? A lot in that. One is these Chinese stocks, and really these are. It's hard. It's really hard because I did see some news commentary on Alibaba this just a couple of days ago about their turnaround strategy for the next 2 years. It's down like 60%. Shares are down 60% from the peak. So it's a massive sell-off, and I love the company. I think it's a great company. But it's with these Chinese stocks, it is really tough because it is an existential question. Okay, with the Chinese government, with their interference, how they want to control things, it is a do or die question. Okay, does the Chinese government really put the finger down on these companies, and what happens when that happens, or do we see them go back to where they were and be able to be companies in their own right? I do like. I like Alibaba better than any other Chinese company. I will say that. I think you can start. You can start buying in at these levels. I would, again, pretty much like any stock. I wouldn't make it more than 3 to 5% of your portfolio anyway, because what happens if the other side of the story comes out and you lose your money in the stock? So I wouldn't make it more than 3 to 5% of my portfolio for any stock, especially one of these. But I do think you can start building a position in these. It does have a turnaround story. Like I said, it is a strong stock. It's trading for peanuts compared to Amazon or compared to some of its other competitors. Tencent, really haven't looked at that quite as much. It's already on the OTC market, so not a lot would probably change if a lot of these Chinese companies were delisted. And we did a delisting video here a couple of weeks ago where really understand that if you own shares of a company trading on the U.S. stock exchanges, they get delisted, whether through their own, actions or something else. They still trade on the OTC, so those stocks, those shares that you own will just get transferred to the OTC. You'll still, most investing platforms will still allow you to buy and sell those. So you can still sell those shares if they do go to the OTC market. In the case of Baba, in the case of, I know Didi is actually actively in the process of delisting from the U.S. market, going to be trading in Hong Kong, but those shares, those U.S. shares, will still be traded on the OTC market. So, it's not a lose all your money type of scenario, but it still will shake a lot of the funds out, a lot of the institutional investors out, and it'll hurt the shares. So on anything other than Baba, and I don't even think I would be in Baba for a long-term play just yet, because I think the tensions, the geopolitical tensions, are still rising with China. So we still could see more action against a lot of these companies as far as delisting and that kind of thing. The Chinese economy looks like it's getting worse. We're actually probably going to see a cut in the prime loan rate by China. I think tonight, actually. So China obviously opens earlier, and the central bank is expected to cut the prime loan rate, which will support the economy, will support higher economic growth. But just the sell-off in these property stocks and the property sector is so bad that I do think the Chinese economy gets worse. China wants to control more of the economy. They want to control it to head off any social unrest, anything like that. So I still think the bottom might not be in a lot of these Chinese stocks. That said, I do like Alibaba, and I think you can start building a position in that. Just don't make it too much of your net worth. Mark says, will PayPal and Square thrive during inflation? I think Square will thrive when Bitcoin rips. I like Square. I like PayPal and Square. I own shares of PayPal. I love both of those as a digital wallets play. I think digital wallets, digital finance is going to be the de facto way we handle money. It's going to replace banks over the next 10 years. And I think PayPal and Square are probably the best positioned for that with their digital wallets apps. I like PayPal a little bit better because it's more of a pure play in that idea, in that theme. Square, Jack Dorsey, it's not even Square in that anymore, right? It's Block. Dorsey has taken that company much further into Bitcoin. And honestly, if I want Bitcoin exposure, I'll buy Bitcoin. And I do buy Bitcoin, okay? I get my crypto exposure through the currencies themselves. I want my companies to be a little bit different. I want my companies to be, focusing on something else like PayPal is doing. Obviously PayPal still has cryptocurrency services, things like that, but they're not quite as heavily invested or as quite as heavily related to Bitcoin as Square is. So, PayPal for digital wallets and for that financial, digital finance space, Square and Bitcoin itself for the cryptocurrency investment. Square is kind of caught in between. I don't think it does either one of those better than PayPal or Bitcoin can. But as far as inflation, I mean, with inflation, and I do think inflation is still going to turn out to be higher than expected. While I will say that, with the Omicron surge, I think people are going to bring their inflation expectations down a little bit. They're going to bring their rate hike down expectations down a little bit. That's going to help these growth stocks. But over the longer term, as we get into the second quarter of the year, even longer into the summer of the year, part of the year, I still think inflation is going to surprise on the upside. A lot of investors, a lot of economists, the Fed, still thinking inflation is going to come down to 2-3%. If you look at the bond market, 10-year Treasury rate is 1.4%. There is no way in hell the 10-year Treasury rate should be 1.4% if if inflation is at 6% and expected to stay there. So the market is telling us that they don't believe inflation is going to stay high. Even as the Fed has admitted inflation isn't temporary, it's going to be more persistent, the bond market is still saying, no, it's probably not going to be that bad. Okay, so I think as you start seeing inflation stay higher, not 6%, but maybe 4 or 5% through the 2022, through this next year, you're going to start seeing these growth stocks get hit, and PayPal and Square aren't necessarily quite the growth stocks that some of these others are, like this CRISPR, like a Teladoc, like some of these other really expensive growth stocks. They are still a little bit pricey on that growth basis. So, I think that's inflation is more of a disruptor to these stocks than it is support. But I still think they do well as far as that longer term kind of trend towards digital finance. What else we got? Who's seeing Spider-Man tonight? This guy. If you've already seen it, don't spoil it for me. But I've heard it's really good. But what else we got? Just a little aside there. Stocks are a year low. 8 to 10% of reality. I think Citigroup would be a good pick for what's coming with the Fed decision. Okay, Homer's Reluctant Odyssey. I love that name. That's kind of cool. I like that name. Homer's Reluctant Odyssey wants to know if Citigroup would be a good pick for what's coming with the Fed decision. As far as, the Fed had its decision last week, so there's no real imminent Fed decisions. Now, I do think, so the bank stocks, not just Citigroup, but the bank stocks overall, I think could get hit or are at least going to be under pressure over the next couple of weeks if we do see, interest rates stay low on that Omicron surge, right? Because banks make money when interest rates go up. As well as, I think if we see the Omicron surge, people are going to get kind of worried about the economy, okay? So the Fed is pushing up short-term rates. The economic worries are keeping long-term rates down. That's going to level out. It's going to flatline the yield curve, which is very bad for banks, right? Because they pay you the short-term rates and they lend out the long-term rates. So they're not going to make any money. So over the next 2, 3, 4 weeks, I think the banks are going to be under pressure as well as a lot of these cyclicals. But I do, like I said earlier, I do think it's a buying opportunity. I think, I think they do well, over the. I just saw somebody said Spider-Man dies. Yeah, thanks, ass. Now, I heard he's already committed to 3 more movies, so whether he dies or not, he's going to be alive. Tom Holland's going to be Spider-Man, so one of the Spider-Man dies maybe. Don't spoil it for me, dick. But anyway, so yeah, I think Citigroup, the banks in general do well. I think that, like I said, even if expectations for a Fed hike comes down from 3 to 2, they're still going to be hiking this year. Interest rates are going to go up, especially as inflation stays higher, and I think the banks are going to do well. Spider-Man dies. What? You're killing me. Thoughts on REITs? RJS ENT. Don't know if that's RJS Entertainment or what. I think I had that RJS Entertainment applied to my credit card at one point. Let you draw your own assumptions there. Thoughts on REITs? Real estate, I like real estate. I mean, it's not just because I started my career in real estate, but because real estates are a good asset, a hard asset, so they keep their value during inflation. Now again, and we did a real estate stocks video a few weeks ago. Look that up on the videos tab in the channel, because you gotta think in different property types in REITs. Not all REITs will do well. Especially, I pointed out in that video the storage stocks, the storage REITs, had a great last 2 years. They're up like something like 30% a year for the last 2 years. That just does not happen, and especially with a hard asset like these. So I wouldn't be looking at storage REITs. I think those are expensive and pretty much at their peaks. But some of these other property types should do really well. I like healthcare facilities, things like that. I think residential should do well. Maybe not quite as well as it has been, but residential could continue to do well. I think office space could surprise higher on REITs. Obviously, not in the next few weeks, because Omicron is going to have people rethinking that back to office plan. But I think people are going to start going back to the offices here next year, and office REITs have been sold off so dramatically that I think they're a really good value right now, and I think they'll do well. What else we have? Dario, $5 super chat. I appreciate that. Thank you. Our MLP is a good investment, even though the share prices have been falling and they have high yields. Well, I mean, high yields are basically because they have to pay out that cash flow to keep their tax preference. And yeah, some of the share prices have come down, so they the dividend has gone up, the dividend yield. Let's look at my favorite MLP here, Energy Transfer, and we'll look at the 1 year. I'll show you my screen. Okay, so the 1 year on Energy Transfer, one of the best REITs, 7% dividend yield, which is really hard to beat, and the price action on it has been decent. So it's a good return. Now it has been coming down, so we can look here since, what do we see here? Since June of this year, REITs have been coming down, or this stock, ET or larger REITs have been coming down quite a bit. That's brought up the dividend yield, but it's still, I mean, we still have a good amount of demand for these pipeline services. A lot of this is a function of oil prices. Even though they have some of their contracts locked in, so irrespective of price, but they still have some price reaction there. But these are 7% yield. It's hard to beat that. It's hard to beat the fact that they will do better as I think as interest rates rise. I mean, they have been obviously historically weak. Really weak over the last, during that pandemic sell-off in oil prices. But I like I said, I like ET. I like MLPs on a larger basis. They are kind of a nuisance for taxes, but I think you can hold them here. I mean, hell, you get a 7% yield, if nothing else. You get pretty good value here. You want to look at the price to discounted cash flow. So the price to cash flow basis as far as valuations, not price to earnings on these stocks. And I think you'll find they've got good value in that price to cash flow, and they've got great yields. And I think you can hold these back to $11-12 at least a share, which is that's a 25% return on top of that 7% yield. So I think you hold these and wait for them to go higher at this point. What else? Okay. So loser stocks, winners. No character ever dies. No Marvel character ever dies except for Black Widow. Canceled that ass real quick. Now I like Black Widow. She did get her own movie. It was kind of after the fact though. But yeah, no Marvel character ever dies. They just change actors and they reboot. Okay, so they will save Spider-Man, as Keebler says. But yeah, I've already heard. I mean, Tom Holland's coming back for three more. Three more Spider-Man movies. I don't know how that's going to work out, whether he dies or not. Thank you very much, but I'm going to go see the movie anyway. So, what else? Okay, we got in February, Spider-Man dies for a decision. Trying to remember this. No, I don't remember that. Yeah, it would help. I'm laying in sun. I'm not seeing questions. Remember, if you ask a question, use a question mark so I can see it real easy, real quick in the chat here. Noel Bossard wanted to know about Neo earlier. Again, Chinese stocks really, really tough. Compared to the more certainty you get with some of these other, even other foreign companies that are not at risk of being delisted or at risk of Chinese intervention. So it really makes them uninvestable at this point. I know you see the stocks down 20, 30, 40, 60% in the case of Alibaba, and they look like screaming deals. But I would go with a different EV. In fact, Wednesday, I've got an EV stocks video coming up. 7 stocks in the electric vehicle space that aren't NIO, that aren't Tesla, maybe not quite as well known or not quite as talked about as some of those popular names. So check that out. But yeah, I think you stay. The car makers for EV have really had their day, right? They've already surged. Even some of the legacy automakers have surged on those EV hopes. I think you go further out right now. I think you go into the charging stations, which I'll talk about that in that video, as well as the minerals, the miners, the copper. If you look at copper use in EV vehicles, it is about 3 times more copper needed in these electric vehicles than a traditional combustion engine vehicle. Okay, so you've got copper, you've got some of the other minerals, lithium, things like that. And they're actually predicting a shortage, a deficit of copper over the next few years just because of all the copper that's going to be used in these, as well as, if you look at the infrastructure spending that we're going to be doing, a lot more copper demand. So I think you see a real upside to copper, some of these other minerals and metals here in the next few years. So I think that's the way you play EV stocks. Might not make you rich like Tesla has done over the last year, but then doesn't have nearly the kind of risk that you have in Tesla or NIO at this point either. So what else? Olu wants to know, what do you think of penny stocks like On Track? Penny stocks obviously always more volatile than the market, so going to be very much a function of whether the market's rising or falling. So you want to, if you're not investing in them for the long term, for that venture capital 3 to 5 years kind of idea, like I've recommended on the channel, then you really have to time it so you're in your penny stocks when the market is rising, because that's very much a function of what those do. That on track media, I like that one. It's one I've covered on the channel before. I've got a few shares of that, but I'll hold on to that for years, not just over the next few months. Okay. All right. Well, we are an hour and 42 minutes into this. I appreciate it, everybody. Thank you. But I got to get ready to go see Spider-Man. So I appreciate it again. I'm going to try doing these every week. If we can, every Sunday. And then in January, I'm going to start doing a market open live stream Monday mornings at 9 a.m. Eastern. So be watching for that, and I will see you there.